The curious task of economics is to demonstrate to men how little they really know about what they imagine they can design. To the naive mind that can conceive of order only as the product of deliberate arrangement, it may seem absurd that in complex conditions, order and adaptation to the unknown can be achieved more effectively by decentralizing decisions, and that a division of authority will actually extend the possibility of overall order. Yet that decentralization actually leads to more information being taken into account. F.A. Hayek. A free market has what economists call spontaneous order. This is the ability for the market to operate competently, even though there are many moving parts and seemingly widespread chaos. Competitive pressures and voluntarism allow for the efficient use of resources in a free market. A central planner, like the Federal Reserve, does not have the same type of structure. The Fed lacks the proper incentives, doesn't have adequate knowledge, causes a misallocation of resources, and operates in an immoral manner. The main problems of the Fed's ability to act as a central bank are a result of its improper incentives and lack of knowledge. The Fed has political incentives. The decision makers at the Fed are isolated from the consequences of their decisions. The Fed also lacks the proper knowledge. A central bank cannot know all the nuance and details of a complex economy, especially one as large as the United States. The free market, on the other hand, has both the proper incentives and knowledge. The incentives of private industry are profit and competition based. If private financial institutions do not provide high-quality services that respond to the demands of consumers, then they will go out of business. Free market participants are forced to provide others with value and quality. Private firms are directly faced with the consequences of their decisions. If they make a bad investment or fail to provide competitive levels of quality to consumers, then they will lose money. Private firms engage in an action until the marginal cost to continue would outweigh the marginal benefit. Government institutions like the Fed do not have the same pecuniary incentives as private industry and will frequently keep engaging in an action until the marginal costs significantly outweigh the marginal benefits. Firms in a free market also have adequate knowledge to make decisions. The tens of thousands of people that are involved in any individual market transaction each have detailed knowledge about what they are doing that aggregates to form prudent decisions. For example, the number of people involved in producing a computer is enormous. There are the people who mine the metals, create the plastic, provide the trucks and equipment to the miners, design the computer, assemble the computer, build the building where the computer is assembled, market the computer, sell the computer, etc. No central planner has all the aggregate knowledge that each individual actor has when producing a computer or any other good or service. The Fed also causes a misallocation of scarce economic resources. It uses its discretion to change the growth rate of the money supply based on the state of the economy. This discretion is, in theory, supposed to allow the Fed to react to changing economic conditions to help speed up the economy if there is a recession or slow down the economy if there is an economic bubble. However, in practice, this type of discretion is not workable because the Fed, unlike the marketplace, is not somewhat omniscient. There are too many factors and moving parts in the economy for the Fed to adequately decide what the money supply or interest rates should be. Because of this, the Fed will always overestimate or underestimate what the proper money supply should be. This leads to disastrous consequences like cyclical economic booms and busts. Discretion is the problem, not the solution. When an economic recession occurs, the market, by its very nature, self-adjusts through the equilibration of supply and demand. When the Fed steps in to adjust monetary policy or create a new banking regulation, it misallocates resources and further exacerbates economic problems. For example, when the Fed wants to increase investment, it increases the money supply, thereby decreasing interest rates. This makes it cheaper for people to take out a loan. But when the Fed sets interest rates, it does not base them on supply and demand forces like the market would. So, interest rates can be artificially too low, leading to overinvestment. In this scenario, it would have been a more efficient use of resources to save or invest that money elsewhere based on market forces and price signals. The artificial changing of the money supply and interest rates by the Fed distorts price signals in the market and leads to resources not being used efficiently. The Fed's creation of financial rules has unintended consequences on the economy. Capital requirements created by the Fed and other regulators are one example of this. Capital requirements seek to reduce the chances of a bank becoming insolvent. However, they do not achieve this goal and have harmful effects. Capital requirements create barriers to entry for small banks who have a harder time meeting the requirements than large banks. This decreases competition, which results in lower quality banks. These requirements also increase costs for banks, and these costs are passed on to the consumer. There are other negative repercussions of these requirements as well. As one financial commentator noted, when capital requirements are increased, the affected bank can choose to reduce risk-weighted assets by contracting lending or to raise capital organically by increasing earnings to satisfy the new requirement. One way to achieve the latter, in the short run, is to lend more to riskier borrowers, who can be charged extra fees and/or higher interest rates. Capital requirements that seek to reduce risk can end up increasing risk while also reducing the supply of credit. The Fed has no way of knowing what the appropriate capital levels should be. It can only guess. If the Fed sets requirements too low, it will cause too much systemic risk. If the Fed sets requirements too high, it will slow economic growth and create risk in new areas. Banks free from mandated capital requirements keep increasing their capital until any further increases would have a greater marginal cost than marginal benefit based on profit and risk aversion incentives. When the Fed promulgates regulations, there are invariably unintended consequences that create disrupted markets and new evils. Capital requirements are emblematic of this. Financial regulation often hurts the very people it seeks to help. Yet the Fed and other regulators unfailingly love to create new regulations in a misguided attempt to fix every problem. The Fed suffers from a God complex, and criticisms of its actions fall on deaf ears. The Fed operates under the false premise that it should always intervene, regulate, and design the economy to fix every problem. The Fed usually takes the credit and shifts the blame. The financial regulation aspect of the Fed also has moral implications. Regulating economic activity involves restricting the association, property, contract, and economic rights of individuals. Regulation that prevents voluntary and mutually beneficial transactions from occurring is an affront to any meaningful level of liberty. Financial regulation ultimately involves government force and coercion. This intrinsically bad nature of regulation is something that society should be skeptical of. Notwithstanding, certain regulation that prevents one party from harming another can be beneficial and help to promote liberty. This would include common law principles, such as prohibitions on theft, breach of contract, fraud, and negligence. The moral problems of regulation occur when the government goes beyond preventing people from infringing on the liberty of others and moves to suppressing people's autonomy in voluntary situations where no one else is being harmed. Inauspicious paternalism, done under the guise of consumer and industry protection, is not the panacea for society's woes.